So you start your first job, you work 2 weeks, and then you get your first paycheck. And then when you get it, you realize that it's much lower than you expected.
It was totally not worth it. Who's FICA? Why is he getting all my money?
If you don't know anything about income taxes, you click on the right video. Today, we're going to be covering these 4 topics that will help you understand what happens with your money. Let's hit it. So if you're new to this channel, welcome to Books and Beers. I encourage you to subscribe. Every single video we have a beer that goes in line with the video. And today, since we're talking about income taxes, usually target about people that are about to start a job, which means that you recently graduated college. We have a college beer. It just means that it's a cheap beer that you probably drank in college. Fun fact, all American beers like Coors Light are actually twist top. So you do not need a beer opener. So when you look at your pay statement, it's going to look something like this. You're going to have your gross wage, which might be broken down to your hours and your rate per hour. Then you're going to have your deductions, which you're going to cover later. And then you're going to have your taxes. And your taxes are going to be primarily 3. Your FICA Med tax, your FICA Social Security, and then your FICA income tax. But today in this video, we're going to be focusing on your FICA income tax, which is the most important one. Then, depending on your state, you might also have state income tax, which means that your state takes another portion of the income that you made. This statement is from Georgia, which has an income tax, but if you live in states like Florida, which I live in, you don't have state income tax. Now there's a small caveat to this pay statement. In this pay statement, the person who's receiving the money decided to do withholding with the employer. That means that when the employer, when they pay you, they retain the taxes and they pay those taxes directly to the IRS. However, there's an option for you to select that you don't want the employer to retain your taxes. You want them to pay you the entire amount, and then at the end of the year, you go and you pay your taxes to the IRS directly. The people that have their employers not withhold their taxes are usually really rich people, because in their mind they think, I'd rather have that money in my bank account or in my investments generating interest and then paying at the end of the year. The funny thing is that if they actually do earn interest on that money that they pay at the end of the year as taxes, they still get taxed on those interests. So Uncle Sam always gets its part. Now, people understand taxes. They understand that the government is going to take a portion of your money because they need to pay for things like firefighters, police officers, development in your counties, etc. However, what people have issues with is understanding how much taxes they're paying and why. So let's do a quick example. Here's a tax bracket for the 2021 tax year. Let's say that you make $100,000. Think about how much money you're going to pay on taxes based on this tax bracket and making $100,000. So what was your answer? Maybe you went to the level between 86 and 164,000, which is 24%, and you multiplied that times 100,000 and you got 24,000. No, that's the biggest misconception about taxes, because that means that you have a flat tax rate. In the United States, and actually in most countries, taxes are progressive, which means that the more money you make, the higher your tax on that. We're actually going to go and do a quick example with cups and water. Let's say tax brackets are separated into individual cups and your income is represented by a picture of this pink looking liquid. If your calculation gave you that you will pay $24,000 in taxes, it means that you selected one bracket, or in this example, one cup, and just filled it all the way to the top and took out $24,000 in taxes. But that's actually wrong. In reality, tax brackets look like this. Each tax bracket is an individual cup, and as you can see, as you earn more, the tax, represented by the black line, is higher and higher. So if you're wondering how much money you're going to pay in taxes, you need to once again grab your gross income, represented by this picture of pink looking liquid, and start filling up the cups. So the first $9,950,000 get taxed at 10%. Then between $9,951 and $40,525, which means the next $30,000 or so dollars, get taxed at 12%. And then so on and so forth. One thing to mention is that you don't fill the last cup all the way up, since you're not making $164,000, rather only $100,000 in this example. All said and done, this gives you a total of $18,020.42 paid in taxes. So the important thing to note here is that regardless of how much money you're making, if you're an entry-level worker or you're Jeff Bezos making billions, everyone starts getting taxed at the same rate and then moves up the tax bracket as the cups start to get full. So this is all probably starting to make sense, but there's a term that you probably hear a lot called deductions. Deductions are simply things that you can subtract from your income before it is subject to taxation. What that means is that if you make $100,000, if there's certain deductions that apply, you can actually subtract that from the $100,000 before it gets taxed. The biggest two deductions that exist out there are: one, donations. If you ever donate money to a non-profit organization, that being a university or an organization like Doctors Without Borders or the Red Cross or things like that, you can actually deduct that from the money that you pay taxes on. That means that it's less money on that higher cup that gets taxed on a higher tax bracket, and you're basically gonna pay less taxes. The other example is the money that you put into your non-Roth IRA accounts. So basically your non-Roth retirement accounts. If you want more insight about that and you're not sure what Roth or regular IRA accounts are, go back to our last week's episode with Barney, where he explains everything about Roth, non-Roth, and retirement in general. And then another thing that is important to point out is the raising of taxes. A lot of times we hear that taxes are going to be raised, and you see a lot of people arguing that they don't want their taxes to be raised. What people fail to understand is that, at least in the current political climate that we are in, when they say that they want to raise taxes, they're actually just going to raise taxes for the higher bracket. That means that you're not going to be affected by higher taxes unless you make more than $523,000. Now, I'm not saying that raising taxes is right or wrong. What I'm saying is that in the United States, there's a lot of misunderstanding about who's going to get their taxes raised. And finally, you might be thinking, well, why do we declare taxes? Why do we send these papers to the IRS around the April time? When you file taxes, you basically do a calculation and look at all the forms that you have to fill up. And you send those documents to the IRS saying, hey, this is how much money I paid you in taxes, and this is how much money I should have paid you in taxes. And therefore, there's two things that can happen. One, you can owe more taxes because you didn't pay your taxes fully, so you send a check with your tax return. Or two, you can actually get a tax credit, which means that the IRS is actually going to return money. Most of the time, you fall in that second category. The important thing is that you have to file your taxes. If you don't know how to file, there's basically three ways you can do it. You can do it yourself. It is completely legal, and all forms have explanations. You can use one of the internet softwares, which is the most common one, like TurboTax or many others out there. Or if you're a skeptic because maybe you want a person physically doing it and signing it, you can use a CPA or just any accountant that you have in your city. A lot of people go with that third option of using an accountant because there's a chance that you get audited by the IRS. What that means is that the IRS looks at the entire pool of people that file taxes and pick a very small number of people, I think it's like 1%, and say, hey, let's make sure that the amount of money that this person paid for taxes or the amount of money that this person is saying that he or she should get returned in taxes is accurate. And they sit down and they look at your entire return. If it's perfectly good, awesome, because you're doing great. But if it's wrong, you get into a big issue because that's called tax evasion. And that's not something you want to mess with. So before we wrap up the video, I want to rate the beer. I think this is a 3.2. I really like college beers, light beers like this one. And like I did in another episode, be sure that you comment below what your favorite college beer is. The conclusion of this video is a very famous saying that you might have heard in the past that says, don't mess with the IRS. If there's something important that you should do, especially in the United States or anywhere in the world, is pay your taxes. There's a very famous story you might have heard of Al Capone, the very famous mobster, and the fact that he was never caught for doing all the illegal things that he did with the mafia. He was caught only for evading taxes because his accountant was taken into custody and they figured out that he wasn't paying taxes for the amount of money that he was making. So remember that. Don't mess with the IRS because they'll probably get you. Thank you so much for watching this video. If you like it, be sure that you hit the subscribe button and you hit the like button. We've started to do a few personal finance videos and we want to keep going, so make sure that you leave a comment below about what things you want to hear us talk about. You can also follow us on Instagram and see our amazing content there and connect through there as well. Thank you so much for watching, and we'll see you next time.